Hi, welcome to section 7 then of chapter 8, Business and Finance. In this chapter so far, we've been thinking about the different options a business have. We've looked at the banking system. We've looked at this idea of the bank being a financial intermediary. We finished off the previous section there looking at different types of equity finance, all to do with our different types of shares. And now what we're going to do is look at the other aspect, so the other option that we have, which is debt finance. Now, obviously, we need to consider the impact on our gearing, so the kind of proportion of debt we have to equity. But this is often a very crucial part of financing for most businesses. Okay, so the first thing we've got should be relatively straightforward, relatively common. It will be an overdraft. So you guys might have an overdraft yourselves, so you probably know a few of the characteristics of them already. Okay, now an overdraft is just a short-term loan, and obviously you get a limit. So for example, if you've got a £1,000 limit, you can go all the way down to minus £1,000 without being penalised. Obviously you have to be paying some sort of interest on that. Now, we often say, or we always say, in fact, that overdraft shouldn't really be used as a long-term financing option for quite a few reasons, mainly because they're repayable on demand. And that just essentially means that the bank can call you up and say, okay, we're taking your overdraft away. Obviously, they can't do that if you've signed up to a 5-year loan. So it is different to a regular loan. We've got an interactive question here. Let's pretend that this long-term funding solution is to do with buying a non-current asset. So what are the disadvantages, the advantages and disadvantages then of using your overdraft as a business to buy, for example, a non-current asset? So what's good, what's bad? Again, if you can pause the recording, just to see if you can generate a few ideas. Obviously, with these interactive questions, don't worry too much if you're unable to generate ideas right now. It's really just to get your kind of brain ticking over. Okay, so pause now and we'll come back together and have a chat. Okay, hopefully then you've got a few ideas there. Let's have a think if we can come up with some together. So first thing, advantages. Because you only ever pay interest on the actual overdrawn balance, you could argue that an overdraft may be cheaper. Okay, so for example, if I'm not constantly going to be using, let's say it's a $5,000 investment. If I'm not constantly going to be $5,000 overdrawn, then it might work out cheaper. If I take a loan out, I'm going to pay interest on $5,000. If I use my overdraft, and sometimes I'm 2,000 overdrawn, sometimes I'm 5,000, I could end up paying less overall. So we need to be careful because generally overdrafts are quite expensive, but in that sense it could work out better. So because we only pay interest on the overdrawn amount. What else then? Certainly flexible. It's pretty easy to get an overdraft, so you don't have to worry too much about your credit. Well, that's obviously relatively speaking, about your credit rating. So it's a bit easier to obtain than a loan perhaps. Okay, what about drawbacks? Well, we've kind of had the big one already. So repayable on demand. And it just means that it's very difficult to fund a longer term investment if you can't rely on the money being there. We should also put, just to kind of balance the argument, the cost, because generally speaking, if you are consistently overdrawn by 5,000, your overdraft is generally more expensive than other short-term sources of finance. Okay, so be careful. It's I know it sounds like these two things contradict each other, but they don't necessarily, as long as you're considering how overdrawn you actually are. So that's the first source of debt finance that we're going to look at, which is our overdraft. Okay, so if you remember earlier in the previous recording, we did discuss debt factoring, but I basically mentioned the term debt factoring and then moved on saying that we were going to look at it later. Well, here we are. This is now late. And debt factoring is generally, or is to do with your receivables balance. So let's imagine you are a small business that doesn't have a massive finance function, and you decide that you don't have the resources in terms of either expertise or in terms of time, to kind of take care of your receivables properly. And because of that, you're finding that people aren't paying on time and people aren't paying ever, and you're just losing money that way. What a business can do then, and not all debt factoring arrangements will be exactly the same, but generally you can arrange, obviously for a fee, for somebody to manage your receivables function. Okay, so they take care of the whole receivables aspect for you. They will often pay you up front, so they'll forward normally up to 80% of your receivables. So 80% of the money that your customers owe you, they will give you up front. And in some arrangements, which we'll discuss in a second, they will also insure you from non-payment. So if one of your customers doesn't pay, they will take that risk on, and we call that a non-recourse arrangement. So that idea of our customers not paying and us not losing the money, we call non-recourse. So you make sales on credit. Your factor provider will manage the receivables process. So they will obtain the debt for you. They will manage your statements. They will manage everything to do with your receivables. They'll give you 80% of the money up front. And then when your customer pays, you repay, in effect, the 80%. They give you the full amount of your customer's receipt, less a fee. So they're obviously charging a receipt for that. Now you can have recourse or non-recourse. Non-recourse is where you're insured against non-payment. Then this just means that the company that's factoring your debt will have to charge you more. So it is more expensive, but it does protect you. Okay. Term loans are an example of what you just would traditionally associate as a loan. So it's a loan where the repayment date is set. So you borrow money, you know immediately when you're going to repay it. They're not repayable on demand unless you default on your repayment. So it's a lot more like a loan, sometimes from a bank, but not always. Loan stock then is just debt capital. As I said earlier, we sometimes call these bonds, we sometimes call them debentures. Whoops. You'll see these words used reasonably interchangeably. This is just securities issued by companies. So they will issue a bond or issue a debenture, and then you can have a repayment date set, and they can often be traded. We did discuss briefly their leasing earlier as well, and you've most likely seen these different types of leases before, but again, let's just remind ourselves that there are two key types of lease that we need to worry about. So a finance lease and an operating lease, and this is going to dictate how you account for these within your financial statements. A finance lease is where substantially all the risks and rewards of ownership have transferred from the finance company or the bank to whoever's taken the lease on. An operating lease is anything else. Okay, so that's all we really need to know for the exam. Last couple of bits here then, just thinking about different forms of debt. So we've had a look at money market borrowing already. Securitization is just any sort of asset-backed borrowing, so any borrowing that's secured on an asset and can take a number of forms. And then also for certain types of business, there might be some public sector grants and loans available, so often for small or medium-sized businesses and for businesses in certain areas like organic food and that sort of thing. So those things are always important for us to consider. Okay, so the last few bits of chapter 8 then, we need to look at financing a growing business. We've got a couple of interactive questions there for you to have a look at. And then we also need to think about financing exports before moving on to that last piece on your personal finance. So we'll play around with those too. Okie dokie. So first things first, let's have a think about interactive question 3. So interactive question 3 is focusing on a small but growing business. So imagine a business that started out perhaps this year, that's doing quite well, growing, but still pretty small. What do you think it is about that business that might cause problems when it comes to us raising finance or trying to raise money for our business? Again, pause the recording here and we'll come back together in a few seconds and just have a chat through any ideas that you've got. Okay, so let's have a think about any ideas that we might have. The most obvious one is going to be to do with history. Okay, so when you go to, let's say you go to the bank for a loan, they are going to want to see what you've been doing. How reliable are you at paying things back? What kind of risk are you going to pose to them as an investment? And because you've got that lack of trading history, lack of credit, a lack of trading history, that's going to cause you a problem. So it's either going to be expensive or they're just going to say no. Also, considering that a lot of loans are going to be secured on some sort of asset, the business won't have many assets. Okay, so relatively less assets than a big business, so they're not going to have too much that they can secure a loan on. The other thing that we need to consider about, we need to think about is kind of management. So if you're relatively small, you'll probably find that your management have less experience. And if they have less experience, they're going to have less idea about where to go for financing, how to approach the financing problem, and that's just going to cause you an issue overall. Now, that's not to say that there aren't any sources of finance that a small growing business can use. They can use almost all of them, but they just tends to be a little bit more difficult. We've got 4 extra examples here for us to consider. Business angels and venture capitalists are reasonably similar. So they're both groups of wealthy individuals. Business angels tend to be mainly experienced in a certain area, so they tend to invest because they know the area, and generally it's quite early on within the business, so either a startup or some sort of expanding business. Venture capitalists, however, are also a group of wealthy individuals, but they are, I guess, a bit more ruthless. So they want some sort of control, okay, of the in terms of shareholding. They always have some sort of exit plan, whether that means they're going to float or whether they're going to sell on to another group of venture capitalists. And they seek to influence management. So they don't want to run the business, but they want to have influence over management to run the business in the way that they see fit. The alternative investment market, then we had a brief chat about the benefit of an alternative investment market is that it's a bit easier and cheaper to enter. And then finally, we've got crowdfunding, which is a relatively new form of financing. This is just where normally via the internet you aim to attract lots of small investors. So I know that there's been, for example, some music projects and some movies and some video games, but it also can be a small product. So say there's a new mobile phone on the market. The company that's making it is too small to really kind of get the sufficient investment that they need. And they say, right, if you give us £100, we will send you the first model of the phone when it arrives, okay, or when it's ready. And it's just a way of normal people like you and I investing in a product kind of at the start. So, you know, if you wanted to look into it, something like Kickstarter would be an example. Obviously, lots of other examples too. Okay, so that's kind of thinking about that early stage. Interactive question 4 then takes us through a longer example. So here we've got Ian, and Ian's got a sandwich empire. And Ian starts selling his own sandwiches from home. The business develops into a national business over time. And what we want to do is go through each stage and start thinking about possible sources of finance. Now, there's not really an 100% right or 100% wrong answer here, so don't worry too much if you haven't quite got it. But have a read through the scenario. This one's probably going to take you a little bit longer, but have a read through the scenario. Bear in mind everything that we've seen so far, all those different types of financing that we've seen. And have a think when you pause about what's going to be a suitable source of finance for each one, and then come back together with me and we will have a chat through. So if you can pause now and have a go. Okay, what do we have then? So at the startup stage, still really small, still made at home. Most likely Ian's unfortunately going to be delving into his savings, although having read the rest of the example, I would probably put my savings towards something that's going to grow to £50 million revenue. Savings, maybe a mortgage on his house, remortgage or something like that. Okay, so growth to £100,000 per year revenue. So he needs small premises and a van, probably some sort of borrowing from the bank would be appropriate. And if he needs premises, you know, that could be secured, okay, on the premises. So he's continued to grow, and now he's grown to £500,000. Organic just means that he's grown naturally, hasn't bought anybody. Needs new larger premises, so again, most likely to have some sort of bank borrowing, but because he's grown so much, he essentially could turn or become a limited company, maybe get some new shareholders. Okay, so invest some external investors in terms of shareholders. Next up then, we're growing to $2 million revenue, and this is by acquisition. So we've obviously purchased somebody. We've established a brand name, reputation. We want to expand regionally. Again, I guess we've got more shares. Okay, so we've got that option there. And I suppose you would be starting to think about perhaps venture capitalists, although we'll put a question mark there because I'm not sure the 2 million is quite enough yet for a venture capitalist. When we come on to 5 million revenue, I think that's where venture capitalists will start to get a bit more interested. And obviously, sorry, you still have, kind of the option around loans or debentures. So that's not been taken away from us. I've been holding back from the PLC, but I think 50 million probably, we're expanding to national scale. I think probably PLC would come into play here at 50 million. So we can float on the stock exchange, and that will give us lots of nice, lovely shareholders. Okay, so well done if you did well on that. Don't worry too much. As I said, it's a relatively long example. Obviously not going to get that type of example in the exam. Right, last couple of bits. Okay, so financing exports. So obviously there's lots and lots of risks with selling things on credit to customers within the same country as you. And the problem with selling to overseas is that those things tend to be tend to be compounded. So you have an even bigger problem then. So we're going to talk about 4 different types of trading risk when talking. I'd say talking about 100 times. We're going to talk about 4 different types of trading risk when we are considering selling overseas. So first of all, we've got the physical risk. Now, sending something 50 miles down the M3 to a different city nearby is relatively low risk. Okay, so unless there's a big accident on the motorway or there's a big fire or something, you tend to be okay. Sending something overseas via air freight or on a ferry obviously increases the risk. So you might find things are stolen. You might find that your accompanying documents go missing. Obviously, you've also got credit risk as well. So this is where you're going to have default by the customer. Now, the problem with credit risk for an overseas customer is, what do you do? Do you then have to go overseas to find them? What about the local laws in place? So it's just a lot more of a headache for you to have to worry about. Trade risk is where the customer might refuse your goods. So you go overseas, you send your goods overseas and they get rejected. And that's a problem in the UK or in the country that you're trading in. But when you've had to send things overseas, that's even more of a problem. And then finally, liquidity is the inability to finance the credit given to customers. So I've given lots of credit to people overseas. It takes them a lot longer. So you have to give longer credit terms. Well, I say longer credit terms. What I'm really getting at is that it's going to increase your receivables days. Okay, so you're going to have to finance those receivables for longer because of the delivery time as well. What we're going to do then is we're going to pick up on this idea of credit risk and try and think of a few ways of reducing it. Okay, so the most easy one by far is export credit insurance. So you pay a company to insure you against this kind of credit risk. So that can be quite expensive, but it's available. A bill of exchange is where you have almost a bank guarantee. So you have a bill of exchange drawn up, so a document drawn up, which the bank of the customer signs, essentially guaranteeing payment. And then the person who's exporting the goods can then take that and sell it on if they want to for a discount if they want the money a bit sooner. Letter of credits can be examined in a bit more detail, so we're just going to go through a few steps for that one. So what happens is that the sales transaction happens as normal, and then the seller the seller will contact the customer and request a letter of credit. And what will happen is the buying company will contact their bank. They'll ask for a letter of credit, and they will ask for that to be made out to the seller. The bank of the buyer will then check the buyer's bank account, and if they don't have enough money in place to buy it, they'll ask them to perform a loan application to cover the amount. Only when they know the money is there will they then provide that letter of credit to the seller's bank, and the seller's bank will then tell the seller that it's okay to go ahead and send the goods. Now, what we need to bear in mind is the banks don't get involved in the actual transaction. They're just there for the payment. So let's think about that again. The buyer will ask their bank for the letter of credit. Buyer's bank then will check for funds. And once those funds have been confirmed, they will provide the letter of credit to the seller's bank, confirming that the money is in place and they can go ahead and complete the transaction. Okay, very final piece then, just having a quick look at personal financial management. Now, apologies if this seems a little straightforward, but it's on the syllabus, so we need to make sure we've covered it. The green flowchart over to the right is by far the clearest way to have a think about this, and it essentially puts a business type spin on your personal financing decisions. So, as an individual, you're going to have some sort of objective, so something like saving for a house or trying to buy a car. You're going to need to decide what your level of risk is, because that's going to indicate or dictate what type of investment, borrowing you're looking for. You're going to look at your individual circumstances. So are you in a good position to borrow right now? You're going to consider your current incomings and outgoings, and then you're going to think about what I need to do next. Okay, so I need to save some money. I'm quite risk averse, so I avoid risk. I'm in a good spot right now. I'm earning good money. This is obviously a made up example. Good money, and I don't have any other debts, say. Our current income's good. Expenditure's high too, I guess. And then what immediate action do I need to take? Well, maybe I need to go and take a loan out, or maybe I just need to save money, or I need to do this or do that. So you need to, come up with your own example for that. Okay, brilliant. So that's the end of chapter 8. Next up for chapter 9, then we're going to start looking at the professional accountant. So think about what we mean by that, why it's important, and then a few pretty dry bits and pieces around the ICAEW technical competence requirements, the code of ethics, and so on.